The markets are hemorrhaging. If you looked at your portfolio this morning, specifically at the precious metals sector, you likely felt that familiar sickness in your stomach. Silver, the asset that was supposed to be the ultimate hedge against chaos, the metal that literally powers the green revolution, just took a massive 4.6% nosedive in a single session. The mainstream media is already churning out the standard excuses. They are calling it a technical correction. They are blaming it on margin hikes in a global liquidity crunch. On the surface, the math checks out. But ask yourself this: why would the price of the most critical strategic metal on Earth collapse at the exact moment global geopolitical tension is at its breaking point? Why in January 2026, with inflation still eating away at the dollar and supply chains fracturing, is silver being sold off like it's worthless? Here is the uncomfortable truth. This isn't a sell-off. This is a shakeout. You are witnessing a calculated, cold-blooded transfer of wealth from the impatient retail investor to the institutional giants. And looming behind this crash is a silent, brutal economic war between Washington and Beijing over who controls the future of energy. Today, we are dissecting the silver bloodbath. We're going to show you why this margin call was a trap and why the smart money is buying while you are panic selling. Let's examine the crime scene. On January 4th, silver prices collapsed, shedding nearly 5% of their value in a blink of an eye. The catalyst, according to reports surfacing from markets like Egypt and rippling globally, was a sudden, aggressive increase in margin requirements. For those of you who don't trade on leverage, let's simplify what a margin hike actually represents. It is when the exchange, the house, suddenly changes the rules in the middle of the game. They tell traders, to keep your position open, you need to put up more cash right now. Most retail traders and over-leveraged speculators don't have millions in liquidity sitting idle. So what happens? Forced liquidation. The system automatically sells their positions at market price to cover the debt. This creates a cascade effect. One sell order triggers another and another, creating a vacuum where the price free falls because there are no buyers at those immediate levels. This is a textbook liquidity squeeze. But here is the anomaly. Usually margin hikes happen after volatility spikes to protect the exchange. This time, the hikes seem to preempt the volatility. It feels coordinated. It feels like someone wanted to flush the leverage out of the system before the next major move. While the paper price on the COMEX crashed, try buying physical bullion at this spot price today. You can't. The premiums are skyrocketing. This divergence between the fake paper price and the real physical asset is the smoking gun. To understand why silver is crashing while the world burns, we have to look at the macroeconomic chessboard. This isn't about jewelry demand. This is about the economic Cold War between the United States and China. The industrial vacuum. We are living in an era where silver is no longer just money. It is a strategic military and energy asset. Solar panels, electric vehicles, advanced missiles, and the next generation of semiconductors, they all require silver. It is the most conductive element on the periodic table. You cannot build the future without it. China currently dominates the processing and refining of these strategic metals. They control the solar supply chain. The United States knows it is behind. Both superpowers are desperate to stockpile strategic resources. Now, think like a predatory hedge fund or a strategist in Beijing. If you know you need to buy massive amounts of silver for the next decade of industrial production, do you want to buy it at all-time highs? No, you want to buy it cheap. The net zero desperation and bank manipulation. Consider the timing. We are deep into 2026, the critical threshold for global net zero mandates. Western solar manufacturers and defense contractors aren't just buying metal, they are fighting for survival. If silver prices run free to their true value, their entire business model collapses. This crash serves as a coordinated reset for these giants. By triggering these margin hikes, the bullion banks created the necessary liquidity to cover their own dangerous short positions without spiking the price. They forced you to sell so they could exit their bad bets. Moreover, this suppresses the one indicator that exposes the dollar's true weakness against the yuan. It is a masterful, ruthless bailout of the Western establishment, funded entirely by your stop losses. The tale of two markets. This is where the plot twists. While the Western paper markets dump contracts, the Shanghai Gold Exchange, SGE, has been seeing massive physical activity. The East is draining the West's vaults. Every time the price drops like this due to a margin event, we see tonnage move from London and New York vaults into Asian reserves. China is likely laughing at these margin hikes. They are taking the physical silver, thanking the Western banks for the discount, and using it to cement their dominance in green technology manufacturing. We are seeing a bifurcation of reality. The West trades paper silver to manage inflation expectations and protect the dollar. The East trades physical silver to dominate global industry. The crash you saw yesterday, that was the friction between these two tectonic plates grinding against each other. So what happens next? The dust will settle. The weak hands have been washed out. The leverage has been flushed from the system. What remains is a market with zero fat, driven purely by physical scarcity. The global supply of silver is in a structural deficit. Mines are aging, ore grades are falling, and demand is exponential. The laws of physics and economics dictate that eventually the price must reflect reality. You cannot print silver. You cannot magic it out of thin air. When the paper manipulation breaks, and it will break, the move to the upside won't be a gradual slope, it will be a vertical line. This is the prelude to a short squeeze of biblical proportions. If you sold yesterday, you did exactly what the institutions wanted. If you held, or better yet, if you bought the dip, you were aligning yourself with the strategic flow of capital from paper to physical. This wasn't a crash, it was a clearance sale for the elites. The question is, did you panic or did you prepare? Stay liquid, stay skeptical.
Happy New Year, ladies and gentlemen. Welcome to 2026. While the world was busy popping champagne and counting down the seconds to midnight, the global financial system suffered a near-fatal heart attack. You won't see this on the front page of the Wall Street Journal, not yet, but the smell of smoke is undeniable. Here is the reality they are hiding from you. As of this morning, silver is trading at $71 an ounce on the paper screens in New York. But in Tokyo, real, physical silver is changing hands at $130 an ounce. That is a near 100% spread. That isn't an arbitrage opportunity. It is a crime scene. Overnight, the Federal Reserve quietly injected $75 billion into the banking system via emergency repo facilities. Why? Because a massive short squeeze is tearing the bullion banks apart. And the trigger wasn't a Reddit forum or a meme stock. The trigger came from the East. China has officially launched its silver weapon, and the supply chain for the West has been severed. The price on your screen is a lie. The panic behind closed doors is the truth. I'm your channel name, and today we are investigating the silence before the explosion. Let's follow the money to where this started, the Shanghai Port Authority. According to leaked logistics reports and confirmed translations of internal directives, at exactly 11:47 p.m. local time on December 31st, Chinese customs officials began rejecting silver export clearances. Containers destined for COMEX-approved delivery warehouses were sealed, stamped export rejected, and held pending regulatory compliance reviews. This is diplomatic speak for a full-blown embargo. But here is the detail that turns this into a thriller. Just hours before the ban went into effect, sources indicate the United States made a desperate back-channel attempt to secure 50 million ounces of physical silver. The proposal was frantic: immediate delivery, payment via U.S. Treasury bonds, and bypassing the SWIFT system through bilateral currency swaps. Beijing's answer was two words: proposal rejected. The immediate fallout was catastrophic for the paper market managers. The bullion banks, the entities that sell silver they don't own to keep the price down, suddenly found themselves in a delivery vacuum. They are short millions of ounces, and the only place to get the metal just locked its doors. This explains the $75 billion emergency liquidity tap at the Fed. That money wasn't for operational maintenance, it was margin call money. It was bailout money to prevent a systemic collapse of the clearinghouses that hold these toxic short positions. And how did the US regulators respond? Did they let the free market discover the true price? Of course not. The COMEX dropped a margin nuke. On New Year's Eve, they raised margin requirements on silver futures by 30%. This is the third hike in December alone. For the uninitiated, when an exchange raises margins, they are forcing traders to put up more cash to hold their positions. If you can't pay, the computer automatically sells your position. This creates artificial selling pressure. It is a desperate, rigged mechanism designed to smash the price down on the charts, while in reality, the vaults are empty.
Now, let's peel back the layers. Why is this happening now? This is not just about trading profits. This is a kinetic financial war. We are witnessing the great bifurcation of the global monetary system. First, look at the paper versus physical divorce. For decades, the price of silver was determined in London and New York by trading paper contracts. If the price got too high, banks would print more paper contracts to flood the market and drive the price down. It worked until the metal ran out. Look at the numbers. In Korea, silver is $97. In Kuwait, silver is $106. In Japan, silver is $130. The East is trading the asset. The West is trading the debt. When the price of a commodity is nearly double in the physical market compared to the futures market is effectively broken. It is no longer a price discovery mechanism. It is a suppression mechanism. The $71 price on your screen is a ghost price. Try to buy 1,000 ounces at that price for physical delivery today. You can't. Second, consider the geopolitical stranglehold. China controls roughly 60 to 70% of global refined silver processing. By restricting exports, they are not just squeezing a few hedge funds, they're squeezing the U.S. military-industrial complex and the green energy sector. You cannot build Tomahawk missiles, solar panels, or EVs without silver. By cutting off the supply, China is forcing the U.S. to burn through its strategic reserves, if any even exist, or print money to buy metal at exorbitant rates on the black market. This is resource nationalism weaponized to destroy the purchasing power of the dollar. Third, notice the domestic crackdown. Washington State, historically a hub for privacy-minded bullion investors, just reinstated a tax on precious metals after a 40-year exemption. Why now? Because the government knows the exit doors are closing. They are erecting financial Berlin walls. They want to make it expensive and difficult for you to exit the fiat currency system. When a government starts taxing the lifeboat, you know the ship is sinking. Finally, the bailout of the shorts. The $75 billion repo injection is the smoking gun. It confirms that the banks are net short and trapped. If the price of silver were allowed to rise to the Japanese level of $130 in New York, the losses for these banks wouldn't be in the billions, they would be in the trillions. It would wipe out the equity of major Wall Street institutions. The Fed isn't fighting inflation anymore. They're fighting the insolvency of the bullion banks. So what happens next? We are in the eye of the storm. The COMEX margin hikes are a delay tactic, a desperate attempt to kick the can down the road one last time. They hope that by crashing the paper price, they can scare you, the retail holder, into selling your physical metal back to them. Do not fall for it. The disparity between $71 and $130 cannot exist forever. Nature abhors a vacuum, and markets abhor a price gap. Eventually, the paper market will break. The exchanges will declare force majeure, meaning they will settle your contracts in cash because they have no silver to give you. When that happens, the price doesn't just double, it goes vertical. We are looking at a repricing of reality. The verdict is clear. The year 2026 will not be about investing, it will be about possession. If you can't touch it, you don't own it. If it's in a vault in London that you've never seen, it's not yours. If it's a paper contract, it's a promise from a bankrupt entity. China has made its move. The Fed has printed its response. The war is no longer cold, it is red hot, and the battlefield is the silver market. Watch the premiums, watch the repo market, and most importantly, watch out for the moment the COMEX simply stops trading. I want to hear from you in the comments. Are you seeing physical silver shortages at your local dealers? Or do you think the Fed can print their way out of a resource shortage? Subscribe and hit the bell, because in a market moving this fast, yesterday's news is today's bankruptcy.
They didn't just tap the brakes, they pulled the emergency lever. While the financial news networks are distracted by the stock market's daily noise and the political circus in Washington, a catastrophic signal just flashed in the precious metals market. The Chicago Mercantile Exchange, the entity that effectively controls the global price of silver, just executed a midnight massacre on traders. In a move that stunned the trading pits, they hiked margin requirements by nearly 30% overnight. This is the financial equivalent of changing the locks on the doors while the house is burning. But you have to ask yourself, why? Why now? Why would they intervene so aggressively when the price was simply finding its fair market value? They will tell you it is to reduce volatility. That is a lie. The truth is, the silver market is undergoing a fundamental mutation that the central banks and bullion dealers can no longer control. The paper market, the world of futures and derivatives, is trying to suppress the price to maintain the illusion of a strong dollar. But the physical market, the real world of industry and manufacturing, is screaming that there's nothing left to sell. We are watching the breakdown of the silver pricing mechanism in real time. The spreadsheet says one thing, but the empty vaults say another. Today, we expose the data they are trying to hide.
Let's look at the forensic evidence of this crime scene. We need to strip away the jargon and look at the raw mechanics of what just happened. The CME Group issued a notice updating the performance bond requirements. To the average person, this looks like boring administrative paperwork. To a veteran trader, this is a weapon. Until just a few hours ago, if you wanted to hold a standard 5,000-ounce silver futures contract, you needed to post approximately $25,000 in maintenance margin. That was the cost of admission. But overnight, that requirement spiked to $32,500. That is a $7,500 cash call per contract. Think about the mechanics of that. If you're a hedge fund or a large trader holding 1,000 contracts, you were just handed a bill for $7.5 million, payable immediately. If you don't have that cash sitting idle in your account, and most traders don't because capital is meant to be deployed, you have only one choice: you must sell. This is a mechanical maneuver known as a liquidity squeeze. The market makers know exactly where the pain points are. They know that the market is long. By hiking the margin, they trigger a wave of forced automatic selling. Traders aren't selling because they believe silver is overvalued. They aren't selling because the fundamentals have changed. They are selling because the exchange put a gun to their head. This creates a cascade. The price drops on the chart. The technical indicators turn bearish. The weak hands get washed out. The media runs headlines about a silver crash. But this drop is artificial. It is a paper event. It has nothing to do with the reality of mining geology or industrial demand. In fact, while the price was dropping on the screen, the premiums for physical bars were rising in the real world. This divergence is the smoking gun. It proves that the price you see on your screen is no longer a reflection of value, it is a reflection of leverage. To understand why they are so desperate to crush the price right now, you have to understand that the silver market you knew 10 years ago is dead. It is transformed into a completely different beast, and the old rules no longer apply. For decades, silver was viewed primarily as a monetary metal or jewelry. It was a cyclical asset. If the price got too high, people would sell their silverware, investors would liquidate their coins, and supply would flood back into the market to cool things down. That dynamic is gone. Today, the silver market has been hijacked by the green revolution and the AI boom. We are witnessing a transformation from recoverable silver to consumed silver. The solar panel industry, or photovoltaics, has become a silver vampire. To achieve the net zero targets set by Western governments, the world is installing gigawatts of solar capacity every month. Solar panels require silver paste for conductivity. There is no substitute that offers the same efficiency. Here is the frightening part. When silver goes into a solar panel, it is effectively gone forever. It is not melted down and resold next year like a gold ring. It is locked away on a roof for 20 to 30 years. It is consumed. The industry is now eating over 150 million ounces of silver a year, and that number is growing exponentially. The AI revolution is adding fuel to the fire. Every high-end server, every complex circuit board needed for artificial intelligence requires silver. The CME margin hike completely ignores this reality. You can print more paper contracts to sell. You can hike margins to force speculators out, but you cannot print more industrial conductivity. You cannot margin call a solar panel factory. They need the physical metal to operate. This has created a structural deficit that has lasted for 3 consecutive years. We are burning through the above-ground stockpiles at a rate that is mathematically unsustainable. This brings us to the data point that terrifies the bullion banks, the vault train. We need to look closely at the COMEX warehouses. There are 2 categories of silver in these vaults. First, you have illegible silver. This is metal that is sitting there, owned by someone, but it is not for sale. It is just being stored. Then you have registered silver. This is the metal that matters. This is the inventory that is actually available to be delivered against a futures contract. This is the collateral that backs the entire pricing scheme. The registered category has plummeted. We are down nearly 70% from the highs of a few years ago. We are operating on fumes. When the CME hikes margins, they are not just trying to lower the price, they are trying to stop traders from standing for delivery. They are terrified that if the price stays high, sophisticated buyers, perhaps acting on behalf of industrial giants, will stand up and say, "I don't want the cash profit. I want the 5,000 ounces of metal delivered to my warehouse." If that happens, the exchange defaults, the game of musical chairs ends, and everyone realizes there are 100 paper claims for every single bar of physical silver in the vault. The margin hike is a desperate attempt to keep the music playing for just a little bit longer.
Now, we must layer in the geopolitical accelerant. This is why the supply shortage is unsolvable and why the U.S. market is bleeding. While the West plays financial games to manage the optics of inflation, the East is securing the physical supply chain. We have to talk about the Shanghai Premium. This is the most dangerous number in finance right now, and nobody on CNBC is talking about it. For months, the price of silver on the Shanghai Gold Exchange has been trading significantly higher than the price of silver in New York or London. At times, this premium reaches 10% or more. What does this mean? It means there is a giant vacuum cleaner sucking physical bars out of the West and moving them to the East. It is basic arbitrage. Traders buy the cheap silver in New York, the silver that the CME just smashed down with their margin hike, and they put it on a plane or a boat to Shanghai. They sell it there for a massive profit. The result is a one-way flow of strategic assets. The U.S. banking system, by suppressing the price to protect the dollar in the short positions of the banks, is inadvertently subsidizing China's industrial dominance. China controls over 80% of the global solar manufacturing supply chain. They know they need the metal. They're happy to let the CME smash the paper price. Every time the price drops in New York, China thanks the Federal Reserve and buys more physical metal at a discount. This is not just a trade, it is a transfer of wealth and national security. The US has the paper contracts, China has the metal. In a crisis, you cannot build a missile guidance system with a paper contract. You cannot build an energy grid with a margin call. The West is selling its family heirlooms to pay the rent, while the East is buying them up to build the infrastructure of the next century.
So what is the conclusion for the investor? How do you position yourself when the market is rigged against you? First, you must recognize that the CME margin hike is a sign of weakness, not strength. It proves that the price discovery mechanism is broken. If the market were healthy, they wouldn't need to change the rules overnight to force a sell-off. We are approaching a binary event. Scenario 1. The price of silver is finally allowed to rise to its true equilibrium, likely triple digits, to incentivize new mining production. Scenario 2. The physical market completely detaches from the paper market. We will see a phenomenon known as unobtainium. You will see a price of $30 on your computer screen, but if you call a dealer to buy a bar, they will tell you there is none available, or the real price is $100. The divergence between the spot price and the physical reality is widening every day. The margin hike was an attempt to close that gap by force, but it will fail. You can only hold a beach ball underwater for so long. The deeper you push it, the more violent the force when it finally shoots to the surface. The market is transforming from a casino of paper speculation into a battlefield of physical scarcity. The margin hike is the noise. The vault train is the signal. Do not let them shake you out. They want your silver. They want you to panic sell so they can cover their shorts and ship that metal to Shanghai. The spring is coiled, the industrial demand is voracious, and the vaults are emptying by the day. Sit tight. The real price discovery hasn't even started yet.